Australia's quite a unique market. It's one of the most concentrated markets. And what I mean by that is you've got a huge number of very big stocks at the top end of the market and then a very long tail of small positions. There's some unique challenges that come along with investing in a market like that. For the investor, it's very difficult to express a negative view on that long tail of small weights. So if you want to be negative on one of the big ones and you don't own it, you're taking quite a big bet against the benchmark. For a lot of those smaller weights, if you don't own it, it becomes an irrelevant bet. So that's the first problem. The second problem is when you combine a lot of core Australian equity managers together, because of those huge stocks and sectors at the top end of the benchmark, they end up looking quite similar at the end of the day. So when you relax the shorting constraint and you enable the manager to be able to take a negative view, a lot of those smaller weights can be dialed up. So for example, if you're negative on some of the casino stocks, for example, they're very small in the benchmark. They're only 50 basis points. It's not going to mean anything if you don't own it. You can dial that weight up, or that negative weight up, with a shorting constraint. And then obviously if those stocks go down, you're getting a benefit out of it. The other benefit is once you relax that shorting constraint, you're skewing your portfolio further and further away from the benchmark. So from a blending or a portfolio construction perspective at the asset level, the unit holder's getting some blending benefits. There's lots of different ways to make money on the positive or the negative side, and rather than going through all of them today, it's probably just good to maybe bucket them up a little bit. And we're finding most of our shorts fall into really 4 categories. So the first one is an earnings downgrade or an expectation mismatch, where our fundamental process has highlighted that expectations are too high. The second one is really cash flow or balance sheet stress, and we know overgeared companies tend to underperform. The third one is your typical fraud. This is not really a lot of what we do. Australia is a pretty high quality market, but we haven't managed to find a few. And then lastly, pairs trades. So a pair is really dialing up a huge amount of risk in between a couple of highly correlated stocks or sectors. And basically you're looking to take out some of that, the top down or macro risk in the trade. It's again not a huge amount of what we do. But you may see us do something like that if we wanted to take a view on a certain commodity stock, but we wanted to remove the risk around a movement in the commodity. We're never trying to pick a top, so it's fraught with danger, and as you highlighted, markets can be irrational for a lot longer than we can be solvent. And if we were going to, so valuation is not in the process for shorting. We have seen examples of speculative bubbles or really overcrowded sectors. If we were looking to take something like that on, it would only be if we saw like a catalyst or an event which could see something change around that. And the other part to your question is some of the nuances. It's interesting, when you're investing on the short side versus the long, your problems actually get bigger instead of smaller. So when you're long a stock and you get it wrong and the stock goes down, it becomes a smaller part of your portfolio, i.e. less of a problem. And when you short a stock and you get it wrong, it gets bigger in your portfolio. So risk management is a really key part of what we do. And we make sure that if A, we're getting something wrong, we're managing that position size, but B, if we're getting it wrong, we need to move on. And being an independent thinker, but also having an open mind is really important.